Can you actually time the market, or will you be able to time the market? Do you want to know if you have that superpower? In this lesson today, I'm going to show you how you can see if you can time the market. Now, the fact is, disciplined investing is very easy when the market is in an uptrend, or the market is calm, or the market is peaceful. But discipline is only tested when the market is very volatile, specifically when there's a lot of downside risk. Now, in this exact screen you are showing over here, I'm taking a snapshot from the most recent recession that happened, which is in 2008 in the US market. Although I record this in 2018, and I'm saying the most recent recession is already like 10 years ago. It says that between 1970 to 2008, if you calculate the days, okay, which are the days, which is the exact date that has the highest gain in one day. Again, let me repeat that. What is the highest gain per day between the period of 1970 to 2008? It just happened that, okay, one of the top days where it has the stock market in the US, the S&P 500 recorded significant gains is a date on October 13, 2008. That is the one day that registered the highest gain for the period, again 1970 to 2008. Now let's check at this recorded, and let's try to hunt for this date, right? So if you see that on October 13, what happened before October 13? What happens on October 10? I'm guessing it's October 10 is actually a Friday. So what happens on the next Monday, which is October 13? So you have the previous trading day of about 900 points, and it shoot up to 1,000 points in one day. So what happened is, if I have 100-point gain, and my original point was 900, so basically you have what we call as 11% gain in one single day, and that is record breaking, because some years you want to get 11% or 10% is hard, but on this day alone it gained 11% in one day. Okay, but the ironic about this graph I'm showing you here within 2008 is that between September 2008 to December 2008, the Standard & Poor's 500 US market stock index actually dropped from what point? From 1,003 to about slightly less than 900. So that is about a 30% drop within 3 months. And the ironic thing is, the best gain in terms of daily gain within that period, or even within that year, it's sandwiched between the period where the 3 months or the 4 months time frame where the index suffer 30% loss. But yet within that period of time, there is this one single day which register the best gain for that year, which is about 11%. Isn't that ironic? Now, if you look at this, if you are invested in this timeline, you know that if you did not do anything and you are invested, you know that if you have your 2008 and you invested here, you suffer 30% drop. Fast forward to 2009, even in December 2009, your investment will still be in the red. You are still losing money. How about fast forward another year to 2010? It's likely after 2 years, after you suffer this loss, right? It takes you 2 years to just break even. And for most people, you would have lost faith already because you can't wait that long. What about if you fast forward to 2011? We are talking about 3 years. Again, it's just slightly higher than break even. It's a very sad case, right? 3 years after recession and your investment still just recover slightly before you suffer a 30% or 40% loss. But in the grand scheme of things, you have to look at, let's say if I were to forward this until 2014. So in 2008, your drop over here isn't really significant compared to if you would just hold, sit tight and do nothing. Do you agree? And it will become, what happened here, it will become even not so significant if you were to carry forward and you just extend all the graph until today, 2018. Because what happened here, you would have easily recovered this many times. The stock market always go up in the long term. It's just that you have to have faith to sit through this time, this first 2 or 3 years after your investment recover, and it will reward you accordingly for that. Now, let's look at another example in 2015. In 2015, you know that there's nothing really a big recession happened in the US market in 2015. But yet, you are looking exactly what happened in 2015, whereby within a short few days over here, it dropped from a point of 2000 over to about 1008. So that is about like 10% just within a span of 1 week. Okay, but again, the ironic thing about a time, even like in 2015 when there's no major recession, you will see a drop like that out of nothing. And you can see that the best gain, one of the best gain in during that time, yes, it suffered a sharp drop here, but if you were to have sold over here, you would have missed one of the best gains in terms of daily gains in that year, which just happened one day after the sharpest drop on the previous week, the week before. So if you are saying that market timing works, how can you time this kind of thing to avoid this downside and to capture this downside? Is almost impossible, because even if you sell within a short period of 1 or 2 days, your funds haven't really settled yet. So market timing is really a myth. It's not about market timing. It's when it comes to investing, it's more about the time in the market. Because if you were long enough in the market, even if you suffer something like that, if you are long enough in the market will reward you back accordingly for being a long-term value investor, a long-term holding, because you will have gained more than what you have suffered if you have the faith and the patience and the long-term you to sit through all the market volatility and what you have seen over here and what you have seen over here.